we have Sunil Subramaniam as well as Radhika Gupta joining in to discuss that. To begin with you then, Radhika, I just wanted to understand what exactly your outlook is in terms of what this would mean now for the mutual fund industry as a whole. How are you looking at these proposed changes?
Hi, good morning. So, I think it's a vast set of changes, and these changes have been discussed, one has known that some of this is, likely on the cards. I think the net is products are likely to get cheaper for the consumer, which is probably a good thing. There are some very interesting proposals, particularly around the introduction of performance fees, for instance. That could give, some interesting scope for innovation in the industry. I think the major change is the moving to category-wise rather than scheme-wise TER. And I think that will have very differential impact on different kind of players. So large, medium, small AMCs, I think will all see a very, very different kind of impact. Some will see, perhaps margins shrink. Some will see margins go up. So I think that is the most major one. But we'll have to look at the final contours when this comes out. There's still a lot to make sense of in the document, and it's still only a consultation paper.
Sunil, do you see a big impact on the profitability of AMCs because of this? That's something which everybody wants to know.
So I think that if you look at the listed space, they are mostly the larger AMCs. And as you're aware, Nikunj, this is a high operating leverage business, right? Fixed costs are very, very high. So to that extent that cost-conscious investors would naturally migrate to larger AMCs, I see that from an investor side effect, larger AMCs will get more volume of business. Now, on the commercial aspect of the reduction in the TER, how much they take the hit and how much they pass on to the distributors, again, larger distributors would push back and there would be an arrangement. But it's the smaller mutual fund distributors, right, who would take the biggest hit. So I think the impact on the listed players would be minimized to the extent that they will benefit from larger flows, I would say, because their costs will be much lower compared to a smaller AMC. Within the industry, I expect this move to help the larger players. So from a listed player perspective, I guess these are all larger players. So I think that the pass-on ability of the larger AMCs should be able to protect their margins falling. It's not as if there will be zero impact. There will be some impact, but I think that they will be able to cushion a large part by passing on to the mass distribution. So I think that this move, like I said, it should help the larger AMCs get a larger share of investor-oriented direct business.
Sunil, the debt mutual fund is where the TR, according to what SEBI is proposing, should come below 2%. But can I say that it is already below 2% for big AMCs? So in totality, the impact is not going to be large.
You're absolutely right, Nikunj. Not only that, if you look at the debt side, right, institutions still play a big part, and institutions have driven down expense ratios on debt mutual funds quite some time back. So very few debt schemes were operating at the high level. In fact, if you take another aspect to it, Nikunj, there's a direct impact on investor returns because you're talking about, wherever you have indicative yields, at what rate you're lending to the corporate, what the margin is going to be and so institutional investors are very acutely aware of their returns. So already liquid schemes are at about 10 basis points. Short-term duration schemes are at about 25 to 30 basis points. And medium duration funds, right, I would say whichever the larger players are there, they are all operating around the 1%. So the 1.2 SEBI, the debt mutual fund impact is actually very limited. A few small schemes may be charging very high from the smaller AMCs. But overall for the industry, while on the headline, it looks like a huge drop for debt, the actual TER impact on debt will be marginal because anyway, the cost-savvy institutional investors were driving the TRs down already. So I don't expect that to have significant impact.
Radhika, just before we let you go, final thought as to what portion of this would be passed on to the RTA, the distributors, brokers, etc., and what part is something that the mutual funds and the AMC industry will have to bear?
I think it's going to be very dependent on individual AMCs. I think in fixed income, I disagree with Sunil. For instance, a credit risk fund, if it goes from 1.5 to 0.9 in a large AMC, which is the lowest slab that is proposed, then perhaps there will be some pass down and some will have to be absorbed by the AMC. I don't think in this scenario, in a large AMC case, you may be able to pass down 100% of it. I think that will be hard to do, in my opinion. Some will be passed down, but I think the hit will be collectively taken. Historically, I don't think the pass down has happened to RTA. So I'm not sure that that is likely to happen, although there's no reason that pressure won't be applied there.
Well, Radhika, Sunil, thank you both. Thank you both for joining us and sharing your thoughts. Let's look at AMC stocks, how they've done in last 1 year. SIPs are going higher.